Welcome back to our Financial Facts channel. In our last video, we discussed what is balance sheet. You can find the video link in below description. We have discussed there are 5 important takeaways that every investor has to get from the balance sheet. Those are: number 1, how much capital invested in the business. Number 2, working capital position. Number 3, capitalization structure. Number 4, validity of the reported earnings. Number 5, analyzing the sources of income. Why it is such an important factor for investment? Because due to various reasons, the company stock price might go high, sometimes due to some good news or due to some short-term deals. But if company financials are not good, like if company is gradually increasing the debt by borrowing more loan and not increasing its asset over the period of time, then there are high risk of investing in that company. As an investor, to protect your investment, you need to understand the balance sheet. We will provide you what exactly you need to look in the balance sheet before investing. To cover up each points, today we will discuss about the first point, how much capital invested in the business. Just before going to the detail of the first point, let's just look at what appears on the balance sheet. First part of the balance sheet is asset of the company. Few important types of asset are current asset, which is short-lived like account receivable, inventory, cash, etc. Fixed asset, which is long-lived like land, buildings, equipment, machinery, etc. Financial investment like money invested in other companies. Intangible assets like copyrights, patents, trademarks, and goodwill. Second part of the balance sheet is liabilities. Liabilities are current liabilities, short-lived like account payable, taxes, etc. Debt, bank loan, corporate bond, etc. The third part of the balance sheet is shareholder equity. Equity from the investment. To see how much capital invested in the business, we need to look the combination of the shareholders' equity and long-term debt. This is very useful to know whether company is operating majorly on the equity or operating based on the debt they borrowed. Also, we can make sure right amount of earnings retained or paid as dividend by checking the balance sheet for high growth company and a mature company. If a high growth company with low earnings and if they pay high dividend, then the company may be a speculative. High growth company either should pay low dividend or no dividend. They should retain more earning to grow more. For example, Microsoft's total stockholder equity is $82 million, long-term debt is $77 million. Microsoft is operated mostly based on shareholders' equity. Let's look at another company, that is Sprint Corporation. Its total stockholder equity is $26 million and their long-term debt is $35 million. Sprint Corporation is operated mostly based on debts. In our next video, we will discuss about other factors about the balance sheet. Thank you for watching.